Welcome to FinFocus, a podcast by Calamatta Cuschieri Moneybase. Today we'll be discussing the global markets, AI, and various other topics, including our top picks for the quarter. There's always a lot to talk about in the markets, and this time is no exception. It's an incredibly active time for the markets, let's put it that way. There's been a strong start for European and Chinese markets and quite a difficult start for the US markets and in particular the US equities. As you predicted in our last podcast, the Trump administration has caused some volatility to the markets due to tariffs, which have practically erased all the pre-election gains. And year to date, the S&P is down about 5.3%. So my first question is, do you think that the US markets and the US is heading for a recession?
I think we have no crystal ball. Having said that, this event was also experienced in August 2024 when we had a soft jobs report and the market started interpreting that the US economy will head into a recession. This time it is a different situation. In fact, last week we had a jobs report. It was a good jobs report, pretty in line. And this is why, to us, this market volatility contradicts the economic fundamentals to date. It is a fact that from an economic point of view, tariffs, yes, will constrain consumer spending. Having said that, and this is very important to point out, there are other levers that will mitigate the implication of tariffs. For example, case in point, the price of oil is down around 15 to 17% on a year-to-date basis. Automatically, that will trigger disposable income, for consumers, and as I've said, it will mitigate actually the imposition of tariffs in terms of consumer spending. So this was just one example. I think the volatility we're experiencing today, as you correctly pointed out, this was predicted also in our last podcast, is triggered by the unpredictability, because we knew that Trump would impose tariffs. Mm-hmm. He pointed this out very clearly pre-election. So this is nothing new. It is the unpredictability. Case in point, yesterday imposing 50%, reverting back the 50% within an hour. So this is what we're experiencing now in terms of volatility. So the performance on a year-to-date basis, which, by the way, does not make sense fundamentally, is more triggered by this unpredictability. And this, in actual fact, despite many retail investors and possibly also institutional investors get a bit nervous, we have to acknowledge the fact that it also does create numerous buying opportunities.
Like the rest of us right now, the stock market looks confused. Give the markets uncertainty, and there comes the volatility that comes with that uncertainty, not only on the tariff front, but also on the inflation front, consumer spending. There's a lot of niche subjects and niche items which make up this uncertainty. So you have a recipe for the market to delve on the bad news, rather than on the economic fundamentals, which you rightly pointed out. And even though there was a slowdown, but consumer spending is still strong, and that is a fundamental element in a growth scenario. So I don't see any fundamental weakness. It is, and I feel that after all this, and there will be a little bit more level-headedness, and you can see this level-headedness coming along with the new Canadian Prime Minister, who is meeting the economic secretary next week to try to thrash out on a table rather than through tariff threats, the situation between Canada and the US. So I feel that after all this hullabaloo, hopefully the fundamentals will come out, the noise will abate, and more level-headedness will come through the market.
Okay, which brings me to my next question, because Trump said that the US cannot live quarter to quarter, and that the US needs to detox due to the high levels of debt, which is why Doge came in. And my question was, do you think that the US will emerge stronger once the tariffs settle down a bit and the cost cutting?
No, in economics, this is a normal course of settling, what we call settling. So obviously, when a tariff is imposed, there is inevitably always a consequence. Having said that, there are also positive then consequences. And apart from the economic fundamentals and how tariffs will impact, and we've discussed already a lot about the uncertainty and the volatility, I think a very important point to point out in this podcast is that Trump is very mindful of the stock market. Mm-hmm. We have seen this happening in his previous administration. We have seen this week the White House issuing 2 statements specifically discussing the stock market and its volatility. So, in my opinion, I don't think Trump...
What did they say?
Saying that obviously this volatility is not representing fundamentals. Mm-hmm. Saying that in his encounters with businesses, this is not the view that he's taking in terms of the US economy slowing. So again, as I've said, fundamentally and economically, inevitably there will be an impact on the economy, mm-hmm. but as Alex pointed out, it will be a slowdown, obviously, on what we know today. I don't think Trump would want to be the first president or amongst the few presidents elected throughout all these years to be the one that pushed the US into a recession. As I've said, he's very mindful mm-hmm. sure. of the stock market. A very important point also to point out is that today, as opposed to the 1990s, where we had only 11% of US households invested in equities, today we have 38%. Mm-hmm. So what we're saying there, volatility will naturally impact the wealth effect of people. And this is something that I think Trump will take into consideration. Mm-hmm. And if a remarkable slowdown will kick in, he needs obviously to fix it. I think he's too proud to leave, obviously, the US moving into a recession.
Mm-hmm. I think also today's and tomorrow's CPI and PPI figures will give a little bit of direction to the market. Yes. And if they are benign, or I think the market will be ripe for a rebound. There's also on Friday morning, there's the preliminary consumer the statistics that are coming out. So throughout the rest of this week, there can be a catalyst which would stabilize the market. Obviously, if the figures don't come out well, it will add to the volatility of the market. But as Jordan said, the president is mindful of the market, and I think it is not in anybody's interest, more so Trump's interest, for the market to slide down beyond the correction mode, because for a market to correct, it's just normal. I've been through so many corrections in my career that all these corrections come along. They are forgotten, and it will just be noise. But in that correction, there are opportunities to be made.
I was going to jump on NVIDIA, but let's talk about it a bit later when we talk about AI, and move on to talking a bit about the inevitable. We have to mention that Tesla, for example, is 43% down year to date.
Oh, Tesla, I think
it's still trading at about 131 PE as far as I...
Yes, 113. Now, Tesla, obviously, we know that Tesla did very well when it was formally announced that Elon Musk will form part of Trump's administration. Mm-hmm. So we are seeing obviously the reverse of what we have experienced in the last quarter of 2024 and in the initial days of 2025. Markets were up, Tesla was up at, unfortunately, the detriment to other more fundamentally sane companies such as Uber, for example. There was a negative correlation, Tesla up, Uber down, and vice versa. And now we're seeing obviously that reversing. So Trump imposing these tariff threats, unpredictability, markets moving lower, US markets, we'll discuss European markets also, I think. And obviously Tesla is also being conditioned from that end.
So do you think it's oversold? Or do you think it's fair value?
I remember we discussed Tesla also last time about Tesla. We have, I personally, and the investment team, we have an issue with Tesla from a fundamental point of view. So we continue to see weak numbers, from Tesla.
Weak sales, in fact.
Weak sales. This is more fundamental.
This morning he announced doubling the production.
Yes, but unfortunately those targets are never being met. And this is where we experienced the hype in Tesla of around 120% gain in 2017-18, and then Tesla wiped out all those gains.
In fact, there was a hype in Tesla when Trump took over. Anything connected with Elon Musk went up in an unreasonable way. Yeah. So it's losing the froth, the extra froth, the overvaluation that Tesla had, and I personally am not surprised at the fall. Apart from that, there is competition there. BYD is one of them.
Yeah. It's about 230, so it starts becoming attractive at what levels?
Eventually. I think from a fundamental point of view, we need to see some more downwards pressure on the price. To be fair, he's not helping himself neither. He had an interview this week. They asked him specifically how he's managing his businesses, and he said that he's doing this in a very through a very difficult time, because obviously he needs to manage his businesses and his new position with the Trump administration.
I saw that interview myself, and it was not convincing. He took some time to answer that, and it makes me believe that he's facing difficulty in running the company or the companies. This week he had a couple of mishaps with SpaceX exploding over Florida and a couple of others. So, I'm not a buyer of Tesla at this point in time myself.
Fair enough. So, in contrast, talking about moving on to the European markets, but also using the banks as a transition to the European markets, you're seeing the US banks like Citi down, Morgan Stanley down, and in contrast, European banks are doing quite well, and European markets are doing quite well, with the German market up 13% year to date.
Specifically on banks, I think we have to make a distinction between US and European banks.
Yeah.
So the best performers in November last year till the first 2 days of 2025 were US banks. Why? Because, again, in terms of pre-electoral promises, Trump had also said that he will deregulate, and facilitate banking activities. So this is where we've seen a very strong performance in banks, US banks. Now, the reversal that we're seeing today and the negative performance on a year-to-date basis is more triggered by what we call high beta. Banks are high beta in nature, and inevitably, obviously, the volatility that we have experienced throughout US markets has also impacted these banks. If we believe that the US is not heading into a recession, and if we also believe that the Federal Reserve, will prolong its interest rate trajectory in terms of not cutting rates at a fast pace, banks will continue to do well. And this is obviously a fundamental reasoning that we have seen progressing very well throughout 2022 and 2023. Higher interest rates, banks will do obviously very well. So again, the situation for US banks is not fundamentally driven in my view, but it is more volatility driven at this point in time. So there are no fundamental changes so far. Again, as long as we believe we're not heading into a recession. European banks, contrary to that, first of all, the European market has done very well. But specifically European banks, which by the way are up on average 27-28% on a year-to-date basis, have continued to fundamentally post strong results. We have seen this happening not only in European banks, but consistently also with UK banks. And this is something that, again, avoiding recession in Europe will be also crucial for these banks. To answer your question on European markets, personally, I'm not surprised because there was a huge lagging effect. So, for example, last year, the French market posted for the first time a negative performance of around 2-3%. Why? Because there were geopolitical tensions, political issues in France, but also in Germany. And there was this lagging effect when compared to US markets, which we know that over the past 15-20 years have consistently outperformed European markets. The second point as a catalyst for this performance year to date is the 500 billion fiscal expenditure announced by the new German government. This will be spread over a couple of years, but it is significant. It is around 10% of GDP. So this is something that obviously has continued to put positive vibes in European equities, and this is why the German market has outperformed other markets. So
how do you think the 800 billion package that the EU announced on defense spending will affect the markets?
This is company specific. Ironically, one of the best performance year to date, which is Rheinmetall, forms part of the DAX, which is the German market. Today they announced the results. The equity is up 8% as we speak, obviously reflecting the 800 billion package also. But to be fair, the defense sector, I think, and its performance, its strong performance on a year-to-date basis is not surprising. Why? Because, again, we know that one of the bullying tactics by Trump before he got elected late last year was also him stating about the possibility of pulling out of NATO. We saw a very unpleasant meeting between Zelensky and Trump. I think that has also triggered more positive vibe amongst European countries. In fact, I've read a very interesting article on the Financial Times 2 days ago titled "Trump Making Europe Great Again." Why? Because following that very unpleasant meeting, we have seen an immediate action, okay, and many countries putting affairs that we haven't seen since the Cold War in coming up and executing on a program. This was one of the outcomes, the 800 billion package.
My opinion, about time.
About time.
About time.
Yes.
Why should the EU rely on the US, and why should the US pay for the lion's share of everything when they have their own problems to deal with and they need to cost cut?
Ironically, the only country that paid the highest, spent the highest percentage of GDP in Europe was only Poland. Other than that, the US was contributing heavily to NATO. So to a certain extent, he might be right, Trump, obviously. But this meeting, as I've said, this very unpleasant meeting, triggered some finally unity amongst European countries.
It was a wake-up call, definitely a wake-up call. And the way that the European governments rallied together to rectify the situation and realize that they cannot depend solely on US expenditure, especially where defense comes into it. And obviously this creates also the opportunity of having exposure in one portfolio to the defense sector, either via direct involvement in companies like Rheinmetall, like Thales, like Dassault, like Leonardo. But in an ETF, which inevitably will have all these companies in it, it makes sense to have an exposure, I would say, in a defense-related ETF.
All right. Let's move on to, there's a lot to be said as well, because yesterday there was an announcement that Ukraine has agreed to a 30-day ceasefire, then the Americans are going to take it to the Russians. So that could also positively influence the market in the short term, in the next, depending on the announcements any announcement that might be made in the coming days. So one to watch. Before we're going to move on to AI and other specifics, China.
China, we've discussed China also in previous podcasts. China has lagged for the past 3 years, specifically since 2021. We have seen the Chinese market plummeting by around 50 to 60%. Obviously, this is, to a certain extent, no surprise, even when you had very low inflation figures. Coincidentally, this week, for the first time in many years, China has reported negative inflation. Okay, so we are not surprised that the market was very volatile. There was the issue with the real estate market also in China, etc. So no surprises there. The surprise today, and it's year to date of around 19 to 20% outperformance for the Chinese market, I think is more brought about by the agility and seriousness of the administration, the Chinese government today, in not only trying to tackle this inflation issue vis-a-vis consumer spending, hopefully, but also its agility to help and invest strongly in AI, which also will help eventually consumer spending. And I think one of the catalysts for this performance on a year-to-date basis is this seriousness in them being very, very open to deploy this AI technology as soon as possible. No surprises that the DeepSeek also helped. We'll talk about that, I think, also. But I was pretty surprised how they were very effortful in terms of pushing AI spending, which will obviously has helped markets, the Chinese market prop up.
On AI, it's basically, before we go on AI, I just wanted to mention on the macro that obviously at the moment investors are also moving into fixed income at this time because of the volatility. So there's been a lot of
we have seen
record flows
yes.
into...
Yes.
Yeah, we have seen huge inflows into money market funds over the course of the past days. So when we are seeing huge inflows into money market funds, rationally speaking, we're saying that investors are there, but they're on the sidelines. They are parking their cash, earning some sort of income, but eventually that needs obviously to be also deployed into higher generating assets. But yes,
when the market is ready, because when the market goes down, it's never a good thing. But if you're sitting on cash,
it's a good thing.
It's a very good thing.
Yeah, in fact,
this could be an opportunity in the long term, obviously.
100%.
And today with the money market funds, even the UBS money market funds that we have, you can go in and out on the same day. So you can park the cash there and then move it back out to the markets when the time is right.
Yes, when there is a sell-off mode, inevitably, and we can see the 10-year treasuries coming down from 4.8 in January to 4.28 or 4.27 now. Inevitably, the bond market outperforms. And over the last 3 weeks or so, the bond market actually outperformed. Why? The lesser yield is relative to higher bond prices. So that's where the outperformance came along.
Interesting. All right, so moving on to AI, you mentioned DeepSeek. It was quite a quite a big wave when this happened, and then it's kind of settled down. They weren't sure if they copied or they actually used the data from an already trained model on OpenAI or not. But what I know is that in the meantime, NVIDIA lost 140 billion worth of market cap on Monday alone. It's down 28% of its record highs, and it's down 19% this year. Do you think that this suggests that it's oversold? And do you think it's a good entry point at this point in time?
With NVIDIA, it's more about forward-looking beyond what's happening with DeepSeek. Models are coming out. Alibaba model has hit the market and is quite popular, resulting in Alibaba gaining substantially in market cap. Share price has moved up around 60 to 70% over the last 7 or 8 months. And it's been included in some index as well. So that helps because the index funds will buy Alibaba. And also the relationship with Jack Ma, the Alibaba boss, with the Chinese authorities seem to have been mended. So really there is a threat to NVIDIA, not because it's not a market leader, because there's a wide moat with its peers, and many depend on NVIDIA. But I feel that saying that NVIDIA is a bargain, I don't concur with that. In any sell-off, you've got to go on the fundamentals, on ratios, on multiples. So on the 20th of March, there's going to be a major NVIDIA announcement. Mm-hmm. That announcement may serve as a catalyst for NVIDIA to regain some of the lost ground. NVIDIA will remain a leader, and it will, and it has a head start over all the others. But there are other companies which one would consider. In any sell-off, bargains are produced, but not every sell-off. You have to be very careful that when a share price goes down, it's not automatic that you should buy it. You have to go on the fundamentals. If it looks expensive, then don't do it. Irrespective, this is apart from the fact that NVIDIA is a leader in its sector. It's apart from that,
I think if I made something on DeepSeek, this is where, so this happened, I think, in the last week of January. And this is where the immediate impact on NVIDIA's share price was brought about by rightly so people questioning whether the hyperscalers, Microsoft, Amazon, have spent too much on AI by using NVIDIA's offering. Its effect, DeepSeek, basically can mirror what NVIDIA is doing at a fraction of the cost. With much lower chips needed. So it is a fact that we see this as an opportunity for other companies.
OpenAI is doing, for example.
In fact, yesterday...
Because obviously DeepSeek need chips as well.
Yes.
But they need less chips.
Less efficient chips. And this is something that obviously I think it is a positive from one end because it facilitates entry points for other companies which couldn't afford this huge capex to AI and to actually deploy NVIDIA's offering. But I think it's fair to see a share correction in NVIDIA, first of all, when this DeepSeek announcement came about, but also recently with the volatility that we have seen. I remember very well in our last podcast we discussed NVIDIA and its valuation. And we had said precisely that those equities, being NVIDIA or any other name, which has did so well, become automatically more sensitive to any market moves. And this is what happened with the sector over the past 2-3 weeks. It doesn't mean, as Alex pointed out, that obviously NVIDIA fundamentally is obviously in decline. What we're saying is that competition is kicking in. You've mentioned Alibaba. Alibaba last week announced a new deployment, which are saying it is actually slightly better than what DeepSeek is offering, the QWQ32 offering. And again, even in China, Alibaba and Primus, they have announced a massive capital expenditure over the next year, specifically targeting AI. Let's not forget, Alibaba is the largest merchandiser globally. So NVIDIA...
That's good news for Alibaba, because Alibaba still has not recovered from its highs.
No, it's up 16% year to date. But we've mentioned again, Alibaba last time, the business model is a good offering. It is more the political intervention that Alibaba suffered, like with other companies, from the Chinese government that obviously conditioned the share price.
Because if you see also what's happening in AI, it's fascinating. It's the use cases is there. I mean, if you look at how they're using deep research, if you're researching anything, you can be researching anything. You give it a good brief, you use deep research function. It spends 5 minutes researching 150 web pages, checking that the data is accurate, and comes back with an answer that would have taken you a day, or more. Or you maybe wouldn't have found that kind of the research that it's capable of doing. It's impressive. Yeah. That's sort of a new function that's out on Grok, on X. It's out on OpenAI, on ChatGPT. I mean, it's incredibly useful. I mean, it's replacing Google. A lot of people are using ChatGPT instead of Google for a lot of things. So for me, the question is, okay, so there's NVIDIA as part of the ecosystem, but, I think a lot of people are asking, and we can discuss it maybe in the end as well, of which is the best way to get exposed to AI via ETF. There are so many companies, there's a lot of, it's quite a deep ecosystem. There's Avgo, there's Broadcom, there's a lot going on, there's Taiwan Semiconductors, but personally, I feel that it's going places. I feel that it's really, and for the long term, I think it's here to stay now. In the beginning, maybe we were a bit, uncertain, but the use case is there, and the
use case is there.
It continues to grow exponentially. So it's.
But apart from that, even the applicators of AI, and one sector which I personally focus on is the medical technology sector. And you have a company like GE Technologies, which is a spin-off of General Electric, very successful. And the application of AI is going to propel this company into a very profitable. It's got about 30% of the market already. But the medical technology sector, either through a company like GE Technologies, or again, an ETF which represents the sector, would make a lot of sense. The sector is not immune to volatility, but it's more steady. The volatility in the sector is much less than in other sectors. So it's one to consider.
Definitely. All right, so moving on to the last segment of our podcast, starting with what are your expectations for the coming quarter?
No, I think it's all about Trump and his policies, and obviously that encapsulates the unpredictability. How these policies will impact the Federal Reserve decision-making, I think that's very important to point out, because the market is also very sensitive to the interest rate trajectory.
Yes.
Okay? Whether the Fed will cut rates at the appropriate time or no, etc. So that will be unfortunately dictated by Trump and his unpredictably. And thirdly, and equally important, are basically earnings. So we need obviously also to assess earnings in the coming months. Why? We had relatively good, I must say, strong earnings in Q4, okay? And earnings will give us more visibility and tangibility of where in this case, the US economy is heading. So earnings will also dictate, obviously, where markets will head into the second quarter of this year. I'm specifically saying the second quarter of this year, not for the rest of 2025, because as we know, it became, and we've pointed this out, that 2025 will be a volatile year. But as I've said, it's Trump and his policies, central banks, and ultimately earnings, which will shape up where markets will head into 2025.
The markets will remain choppy and volatile, no doubt about it. Lots of factors. The focus on inflation has somewhat eased, and you see the gyrations of the economic policy of the new US president. But as an investor, even though you see these sell-offs as an opportunity to produce good buys, but one has to be careful that you shouldn't just buy a stock just because it's less overvalued. If it remains overvalued, just be disciplined and wait for better buys. It has to be that way. There is a tendency of if the market falls 5%, you jump in because it's now it's not. You have to be disciplined. Go on earnings. Go on companies which have a good business. They've got a lead in that business. At the end of the story, you're buying good value over there, and after all this is over, and it will be over at some time or other, with healthier economies, and with the Europeans pulling their socks up and making sure that they're in the running. I think that the next 3 months will remain choppy and volatile. But beyond that, unless anything extraordinary happens, I give a lot of importance to what's going to happen to the agreement yesterday between the States and Ukraine, whether the Russians will agree to have a ceasefire. That will have a psychological boost on the European markets, and definitely, especially on the German market. Jordan mentioned that 500 billion package, which has been negotiated through parties which are on the opposite side of the spectrum, and yet they agreed to that. It was part of it is going to have a big impact. France is a good player as well. Italy is a good player as well. It's going up the ranks and being respected much more than they used to be. So the whole scenario is fluid, but I'm not pessimistic at all about the outcome. I'm just simply cautious of when to take positions and when to buy good value, basically.
There are opportunities in the US markets, but there are also opportunities in the European markets, of course. So, moving on, obviously, you need to do your research or Definitely. Use your financial advisor, of course. Okay, so just ending off with the last question, standard question, which is your top tip for long-term value creation. So your top stock pick, one stock that you think.
Yeah, no, I think as Alex pointed out, these corrections give more comfort in terms of entry points. So, for example, we were discussing yesterday Microsoft. Microsoft at 380, 385 is obviously becoming very attractive. Why? Because Microsoft, we know, should form part of one's portfolio given its strategy, its leadership within its offering. Coincidentally, yesterday they have also announced that they continue to see strong growth in Azure, etc. So this is something that I think a retracement to the below 400 levels is an opportunity. We've mentioned Uber last time. I think Uber continues to consistently show its fundamental base remains very strong.
It's been very resilient as well.
Very resilient. Thank you for pointing that out.
When we discussed the last podcast about Uber, they confirmed that there's not going to be any partnership between the Tesla and Uber. So
yes,
Tesla not sharing the technology with anyone else on the taxis.
Yeah, Uber, despite this resilience and this market volatility on a year-to-date basis, is still up around 20%. So I think it has performed very well. Then we've mentioned a lot AI, there are obviously also the AI enablers and the more tangible names. So a name that comes into mind, we've mentioned Salesforce last time, but ServiceNow is also now gaining popularity. They have continued to invest heavily. Coincidentally, this week they have announced the acquisition of a specific AI company. And we have other names which continue to show some undervaluation, such as Adobe, which also continues to push its investment in AI.
As well as Broadcom, which I think would be a core holding in any portfolio. And once the emphasis on AI, again in a balanced portfolio and in a diversified portfolio, exposing yourself to a good ETF in AI, like Global X, have the AI and technology, which is very popular, having all the good names. I mentioned the GE technology, Alibaba. These are all worth considering. And if you see the multiples, they are not expensive. Alibaba is not expensive, even though it's gone up 60-70%. It's at a discount to its peers.
Let's not also discard cybersecurity names.
And cybersecurity, yes.
Coincidentally, during this volatility, we saw also a remarkable retracement in CrowdStrike. We know that CrowdStrike last year had a specific issue which tanked its share price below 230 levels. It was a very nice buy at the time, I remember. It breached the 300 levels, and now with this volatility, it went down back to 310 levels. It was at 300, 301, and this is where I think being constructive, and we know that cybersecurity will remain a very important capital expenditure for any company going forward. So these names are names that on these retracements we need obviously to consider.
CrowdStrike is an example of when a company's share price is hammered because of a specific event. But what is good about CrowdStrike is that their retention of their clients has been almost 100%. The clients did not leave CrowdStrike because of that. This was a serious event, no doubt about it, but still they retained their customer because obviously they retain them because their product is superior to other products or service.
There's also Sentinel-1 in that sector, which is...
Sentinel-1, Palo Alto, these are all names that, are fundamentally sane and obviously are good entry points when we experience this type of retracements.
Okay, good to monitor for the right timing, obviously. Okay, we hope you found this podcast interesting. You can follow us. We do send emails to all our clients when we have a new podcast, but you can also subscribe to our channels on YouTube, Spotify, and Apple Podcasts. Thank you for listening. Keep the feedback coming. Have a nice day.